Hi everyone, and welcome back to the Independent Dollar. If you've been watching our videos recently, we've been providing some strategies and tips to help simplify buying a house here in Canada. So why do you need to be concerned if you're buying a house this year? Well, getting approved for a mortgage just got a lot harder, and if you were pre-approved last year, chances are the amount that you're going to get this year is going to be a lot less. Here's why. One of the biggest hurdles that a lot of new homebuyers face is putting together enough money for a down payment. In Canada, you need to save at least 5% or more in order to buy a house. And while 5% may not sound like a lot, on a $400,000 home, that means a down payment of at least $20,000. And that's before all of the other costs that go into buying a house. What's even more overwhelming though, is that if your down payment is less than 20%, you also need to get approved for mortgage default insurance in order to actually get a mortgage. And that insurance just got a lot harder to qualify for. This year, CMHC, one of the most popular default mortgage insurers, increased the difficulty of getting approved for their insurance by reducing the amount your mortgage payment can be compared to your income. Meaning, you will not get approved for as much of a mortgage this year as you could have last year. CMHC uses two main calculations when deciding whether or not they're going to approve you. The first calculation takes your potential monthly housing costs, so things like your mortgage payment, taxes, and condo fees of the house that you're thinking of buying, and then they compare that to how much money you make every month. The second calculation compares not only what your potential housing costs will be, but also all of your other debt payments, so things like car payments, credit cards, and so on. In the mortgage world, these are referred to as your total and gross debt service ratios. And this year, the threshold for both of them have gone down between 2 and 4%. Now, you might be looking at these changes thinking, that's only a few percent, no big deal. Well, here's how much less you're going to qualify for this year because of these changes. Let's assume that you make about $75,000 a year, either on your own or together with your spouse. You would have qualified for a $380,000 mortgage last year, enough to buy a $400,000 home, assuming you're putting 5% down. Under the new rules this year though, even with that $20,000 down payment, the maximum you're going to qualify for is $360,000. That means in order to be able to buy the same house you could have bought last year, you need to save an extra $20,000, basically doubling your down payment. Or you need to find a way to increase your monthly income in order to get approved for the same mortgage. Well, an obvious solution to this would be to simply put off buying your house until you can get a bigger down payment. This isn't always an option for everyone, especially if housing prices are increasing faster than the rate that you can save. So if you are struggling to come up with a large enough down payment, here are some options that you can explore. The first-time homebuyers plan allows you to withdraw up to $35,000 tax-free from your RSP to buy a home. If you don't have an RSP plan to draw from, you could consider the first-time homebuyers incentive. It allows you to apply for down payment assistance through the government. We have a really great video about this, which I'll include in the description below. And lastly, before you apply for a mortgage this year, ask your bank if they're able to go through another default mortgage insurance provider other than CMHC. A lot of people, including some mortgage lenders, aren't actually aware that there are some other options out there. There are some really great companies that aren't adopting these new tighter rules that you might be able to get approved through if your application would be denied through CMHC.